When we do our client portfolios week over week, we see like one recurring trend, right, Juicy?
Yes, we do.
What's
Comes down, it's the Pac-Man theme that we see over and over and over again. So the reason why I said, listen, there are clear winners when it comes to certain markets and there are clear non-winners comes down to an understanding of how your money is going to perform in real estate over a full market cycle. And what I find is that many people are focused on only one profit center in real estate, which is cash flow. That is what gets the most questions or the most attention in the beginning, especially for newer investors. But when you actually manage portfolios, I've had the blessing of managing over $800 million of real estate portfolios, and we report on their returns on investment every single month. This is a part of being a JWB client. And I look at their portfolios, some that have been owned for 2 years, some that have been owned for 4 years, 6 years, 8 years, 10 years, 15 years. And there's a constant theme. And that is when I look at their overall portfolio, 60 to 80% of their total returns on investment do not come from cash flow. 60 to 80% of their total return on investment comes from home price appreciation. So the reason why I say there are clear winners and clear non-winners when it comes to markets is because home price appreciation is cyclical in your market. If you know what your average appreciation rate is over the long haul, call it 30 years, 40 years, then each 10 to 20 year cycle, you're going to find that that average is likely to repeat. And so if you find the markets out there that have an average home price appreciation rate that is higher than the national average, you stand to benefit from that over the long haul. You'll probably get more home price appreciation. And again, home price appreciation is the biggest driver of your returns over the long haul.
Yeah, got it. So I'm showing here on the screen, if you're listening on the podcast, right? We are showing 4 different portfolios: a client that invested in 2012, a client that invested in 2016, a client that invested in 2019, and a client that invested in 2021. And we talk about it as the Pac-Man theme because we're showing these pie charts. And the pie charts show 4 profit centers. They show the return on investment percentage in cash flow, in tax savings, in principal pay down, and in home price appreciation. And what you consistently see is that the mouth of the Pac-Man, right, the smaller piece of the pie, is the compilation of these 3 other profit centers, no matter what year you look at it. And then the Pac-Man itself, more than 50% of your actual returns, right? And you said, what number did you say? It's
between 60 to 80% consistently.
Yeah, 60 to 80% from like a really wide mouth open Pac-Man to like a closed mouth Pac-Man that's just like sipping on syrup or something like that. And what you see there is that makes up the bulk of the home price appreciation. But home price appreciation is a long-term play. You said it, right? Like you want to be in it for a full market cycle.
Yes.
So in order to make it and get it from that home price appreciation, I think 2 things need to happen. One is you need to be able to like financially withstand it.
Yes.
Right? Like you got to be able to afford the property over that time in order to reap those benefits. And 2, you got to be able to emotionally withstand it.
Yeah.
Right. So,
absolutely.
So it's a little bit of both, which is why we talk about the team is the emotional withstanding, right? Like how well are you being treated? How much do you trust like the information that you're getting? Are you having to deal with the problems or is somebody else doing it for you? Because it'll inevitably happen. But then the financial withstanding has a couple of different approaches, right? You see?
Yeah, it would be easy with this logic that we brought you along through up until now to just say, oh, I'm just going to go find the highest appreciating markets and invest there. But what you'll find with most of those markets out there is that on a month-to-month basis, you will be cash flow negative, right? This is an asset class that is meant to be consistent. It is meant to be reliable. It is meant to produce income each and every single month. And that's because this is going to be a long time before you reap the benefits, the full benefits of home price appreciation. So the problem with going to those markets that just have the highest home price appreciation is most of the time what you'll find is that their rents are not high enough to keep up with their purchase prices. And that creates a negative cash flow situation. So what you're really trying to find is that sweet spot. You're trying to find that market where the rent to price ratio is high enough where you can create positive cash flow situations and there's above average home price appreciation. And of course, there needs to be a team that supports your investment while you're there so that you enjoy this process for the full market cycle that you'll be investing.
Yeah. So if we're talking about like super high home price appreciation, what are we talking about? Like New York and like LA and San Francisco and stuff like that.
DC, Virginia area.
Where that like home price appreciation, the home prices have appreciated so much that there might be rent control, right? Like it becomes like an unaffordable place to rent. So then what ends up happening is you may enter this scenario where on a month-to-month basis, yes, your property is appreciating like gangbusters. But like, I know that when I was doing the math, when I was living in Miami and I was thinking about investing locally, I knew that I had to invest in a property. If I could invest all cash, it's one thing, right? But I wasn't there. I needed to get a mortgage, right? So in order to get a mortgage and invest appropriately, I knew that I'd be coming out of pocket like $300 to $500 a month at the time that I looked at it, right? So that then becomes the scenario where you either have enough income from your W-2 and other endeavors where, hey man, you're good with that and you're like looking at it long-term and you want to have this appreciation on the back end and you can withstand it. Or maybe you're investing in other cash flowing assets that pay that in some kind of like portfolio building way, right? The problem that ends up happening at that point when I was looking at it, I was like, all right, cool, but I want to get more than one rental property, right? Like I knew at the time I was making pretty good money. I could afford like maybe like a $300 to $500 swing a month, but then it would freak me out that what about the months that I have real expenses, A, and then B, if I want to pick up more properties, am I going to go in the whole $2,000 a month?
Right.
Like
it's no longer scalable.
It's no longer scalable based on my income range, right? Like if I was some kind of like, if I made $1 million a year, maybe a different scenario, right? So yeah, so these are the types of kind of like conditions, right? You see, so if we are weighing the pros and cons of cash flow and appreciation, what I've learned in this class and in this show that we talk about a lot, it's like for somebody like me that I want to maximize my return on investment, I want to grow a portfolio of rental properties so I can diversify within the asset class. I want to find that sweet spot of positive to at least break even cash flow with as much home price appreciation as I can is kind of like the simplified way that I've looked at it, right?
Yep. Positive cash flow or break even is like entry to the dance. That's your ticket to get into this game if you want to be successful in rental property investing and have it be a significant part of your overall investment portfolio, right? If you want to scale this, if you want to have 3, 5, 10 properties, it needs to be break even or cash flow positive. That's your entrance to the dance. Once you've accomplished that and you have the right team in place, I'm assuming, once you've accomplished break even, the marginal benefit of additional cash flow pales in comparison if you're giving up growth, if you're giving up home price appreciation to get it. So once you've accomplished break even, you should set your sights on which markets appreciate more over the long haul.